All right, everyone. Welcome to another episode of Retire Ready. I'm David Nicholas, financial advisor and owner of Nicholas Wealth Management, here with Aaron Jones, our financial planner and CPA. We're back.
Pleasure to be here, David.
It's a
Looking
new year.
forward to a new 2024, and it's going to be a lot of fun.
So it's hard to believe that 2023 is behind us.
Yeah.
Obviously, we launched the podcast last year. It's a new year. We're going to try to do our best to get these things out more regularly, but this is going to be an interesting year. I think there's a lot that's going to be happening. So you got election year. You've got geopolitical issues that we're going to talk about. Mm-hmm. You got interest rates. You got the Fed. There's going to be a lot to talk about. So
it's going to be a fun year. It's going to be a lot to talk about. That's for sure.
Yeah, I agree. So one, I think we can look back a little bit on 2023, talk about 2024. Also, I want to talk about this prediction by an economist that, and I will quote him here saying that 2024 is going to be the single biggest crash year that we'll see in our lifetime.
Wow.
That's a bold statement. Biggest crash that we'll see in our lifetime.
Interesting.
So I want to talk about that. Is there any merit to that, any weight to that? And what about market history? When we look back at the markets, what does the market tell us? We had a really good last year. So let's talk about last year, Aaron, a little bit. I have the numbers here for the S&P. S&P was up last year.
About 26%.
Yeah.
In the year.
A little over 25% year to date.
Yep.
Incredible.
Yep. Incredible year.
Talk about the NASDAQ.
Yeah. NASDAQ was up. Let me get that number here.
I'll give it to you. Close to 50%.
Incredible.
NASDAQ was up close to 50% last year, which is hard to imagine. Now, I will say it was led by a handful of stocks: NVIDIA, Facebook, Microsoft.
Yep.
You have these what we call the Magnificent Seven.
That's right.
Where a lot of the gains were focused in there. So, but overall, it was a good year for the market. Now, for many investors, if you look at where the market ended at the end of 2023, the market is about exactly where it was 2 years ago.
Yeah.
So the market did what's called a round trip. The market took a big loss in 2022 and then just made it all back in 2023. So really, investors haven't made anything in the last couple of years. What we've really lost now is time, but at least we're about to a break-even level. The S&P is not quite back up to its all-time highs, but it's at least broken even in the last 2 years. Not great, but at least you're not still down 20-30%.
So talk to me, David. If you think back to your December 2022 self, would you have reasonably predicted that the S&P would end the year up 25+%, the NASDAQ would be double that, based on everything they were saying about continued rate increases, potential pauses, geopolitical issues that were still ongoing at the time?
Yeah.
It's a pretty nice year for the markets, given really what happened in 2022 and what was still ongoing.
2022, I know we're going back 2 years. 2022, to answer your question, at the end of that year, you had inflation surging.
Yep.
The Feds raised rates in 2022. We started to, I forget the exact number for 2022, but you had inflation surging.
Yeah.
It almost seemed like the world was falling.
Yeah. And
this is why when it comes to investing, where do you make your money?
Yeah.
When the skies are blue and there's nothing to be concerned about, that's when it feels better. You see the market going up. And as investors, we say, oh, the markets are going up. I want to put more money in the market.
Yeah.
But really, it's at the end of 2022 when the market was down to over 20%.
Yep.
When inflation seemed like it was surging, when it seemed like the world was ending. That's when we want to be putting money to work. But it's so hard as investors to do that because as humans, I think it's just the way that we were made, but when bad things are happening, we think bad things are going to continue. And then when good things are happening, we think only good times are going to continue. It really pays to be contrarian.
Yeah, that recency bias is really tough to get a handle on your emotions in terms of investing.
Yeah.
Right?
Yeah.
When we're like, hey, the world's falling apart, inflation's crazy, geopolitical issues are going crazy. It's easy to expect or think that bad things will continue to happen.
Yeah.
But the markets have proven to be resilient.
Yeah.
Both last year and even history would tell us that more often than not, if there's a bad year in the market, the next year is likely positive to some degree.
That's right. That's exactly right. My joke is to paint the picture. Whenever you see the Chinese troops coming over the border, start buying.
Right.
Because I know it's an extreme example, but it means when it looks like everything's falling apart, that's the perfect time to start buying because if markets are selling off, you want to be buying on wings. We're going to talk about China. I hate to even joke about that, but we're going to talk a little bit about that in the show today. Let's talk about Harry Dent. So economist Harry Dent, U.S. economist Harry Dent, recently warned, and I alluded to this, that 2024, which is the year that we're in, would be the biggest single crash of our lifetime. I'm going to quote him saying, He goes, this is the one time I'm telling you, do not listen to your financial advisor, quote unquote. Things are not going to come back to normal. In a few years, we may never see these levels again. So the question is, how big is Harry Dent predicting that the crash will be in 2024? You ready for this? 86% crash for the S&P 500 and a 92% crash for the NASDAQ.
That's sizable.
Yeah, sizable, you think? So that's no question, that's a dire picture. Now, again, these are attention-grabbing headlines.
Yeah.
So news agencies love these types of headlines because it gets people interested. I actually had quite a few friends and clients message me about, David, I read this. Is there any weight to this?
Yeah.
So let's talk a little bit about this. So what is 2024 bringing us this year? It's the start of the new year. How's the economy doing? If you have to gauge the economy right now, what grade would you give it?
I mean, we've seen it slow, right? Manufacturing has slowed down a little bit. Americans are still proving to be resilient, though. Jobs are still strong, right? Inflation's starting to come down to a level where the Fed's more accepting of it now.
Yep.
And so, while it took some time to get here, 2 years versus the, few months the Fed was hoping for when they first started those rate cuts, right? We're getting to more of that quote unquote soft landing the Fed was really hoping for.
That's right. That's right.
Still more to do, still some work to do, but it does look, I would argue, a little bit more promising than we could have hoped for.
Well, and the baseline estimate for most economists is that we've hit a soft landing, or we're going to see a soft landing this year.
Yep.
So, like what you just mentioned, growth is below potential, but we're still growing. If you look at jobless claims recently, it was below estimates.
Yep.
Job growth has been above estimates. Now, here's what the numbers don't tell us: we are creating more jobs, which is a good thing. But do you know where those jobs are being created?
Specific industries,
government and healthcare.
Yep.
So the government's handing out more jobs than Oprah's handing out free cars.
Free gifts.
I mean, they're hiring like crazy. Is the government hiring a true testament of growth in the economy? It's
Probably
not. Healthcare. I know your family's in healthcare.
Yeah.
My sister and brother-in-law are physicians, so I know that sector. I've experienced that sector. Healthcare sector is hiring like crazy.
Yeah.
But again, is that a true picture of the economy?
Not in terms of demand.
Not in terms of demand.
No.
And here's the other thing. The Federal Reserve is raising rates. They had been raising rates. Now we're talking about cuts in rates.
Mm-hmm.
But the interesting thing is the two sectors of the economy that are hiring the most, government and healthcare, the Federal Reserve has almost no influence over those two sectors.
Yeah, none.
Does the Federal Reserve have influence over when people get sick?
Nope.
No. Or when they're going to need care for healthcare? No. Does the Federal Reserve have any influence on the budget for federal government or state governments? No, they don't.
No.
So the interesting thing is, why are we still seeing growth in the economy? We're still seeing growth in the economy because the Federal Reserve does not have the tools to address wage growth and employment growth in those two sectors, namely healthcare and government, which is what's still supporting this economy.
Yeah. Yeah.
So you've got that scenario, you got a soft landing scenario. But the other scenario that not a lot of people are talking about is what we call the no landing scenario.
Mm-hmm.
So no landing scenario means what? It means we don't land.
Right.
The plane has enough gas in this that we're staying in the air.
Yep.
Like, it's not a soft landing.
Right.
It's not a hard landing. It's just we're not landing.
Yep.
The economy's doing great. We're creating jobs. A no landing scenario would be bad for stocks and bonds, except that we're continuing to see growth.
Mm-hmm.
So I am in this camp that we may actually see this no landing scenario where then the Fed really says, because a soft landing is easy for the Fed. Hey, we've made it, we've achieved it, and let's move on. Yeah. A bumpy landing or a hard landing, I would say, is easy for the Feds. If we have a hard landing, meaning the economy crashes, what does the Fed do?
Yeah, they stop raising rates, they cut rates.
They cut rates, right. They start stimulating the economy.
Yep.
But the no landing is one where you're in this gray area of, do we raise rates? Do we cut rates? And I think you actually end up raising rates again if the economy doesn't slow to the degree that I think the Fed would like it to.
Yeah. Yeah. I've certainly been of the mind that the Fed is more likely to have a longer pause than what most people would expect.
Yep. Yeah.
Right? Yeah. They announced late last year that there was an expectation that rates would come down this year. Right. When was really the big question, but the market's kind of already pricing that in at the time.
That's right. That's right. That's right.
And so I was saying, maybe late Q2 quarter 2, early quarter 3 is really when you might see the Fed start talking about decreasing rates. I think they want to see where inflation stays. Because while the main two sectors of the economy that are continuing to grow, continue to produce jobs, are government and healthcare, the rest of the economy is started to slow, but it hasn't slowed to the degree I think most people expected it to.
That's right. So
I think they want to see what are the real effects for a few more months of these rate hikes we've done over the last 2 years.
Yeah. So I tend to agree with that, but the market is not. That's not what the market is pricing in. Mm-hmm. I got to look at the Fed funds rate. The market is pricing in.
So was it 6 rate cuts for the year?
6 rate cuts.
Yep.
For 2024.
Yeah.
I mean, are you kidding me?
It'd be substantial.
So I joked. My daughter Bella was here at the office, and she doesn't. She's 6 years old, and if she sees red on my phone, she goes, "Daddy, that's bad for the market, right? Green means good,
right?"
And so she drew a picture, and it was of the stock market, and she wrote on it, "The stock market is high today." Nice. And I was like, you know what? That could be interpreted both 2 ways, and I think they're probably both true.
Yep.
I don't know what the market is smoking.
Right.
6 rate cuts in 2024.
It's generous, to say
that
the
is
least.
generous.
Yeah.
So that's essentially the market is pricing in that there's some event's going to happen. Mm-hmm. I hate to say that the market is a lot of times right, but 6 rate cuts seems excessive. What if there's not 6 rate cuts? Mm-hmm. The market's pricing that in. You could see a lot of volatility for the market.
Yeah.
And so my take on this Faber really warning for the economy. I'm sorry, Harry Dent's warning for the economy is, how do we get there? 80 to 90% drop in the stock market. That's Great Depression era.
Yeah.
I mean, that's like end of the world, end of the economy type moves.
It would be double the loss you experienced in 1 year during the Great Depression.
That's right. Exactly. That's a good data point. I am hard pressed to think that'll happen this year. Mm-hmm. But where is the risk in the economy? Maybe we could focus on that, because then I do want to talk about what does the market tell us about. We had a good year last year. So what does that tell us for this year or next year? Here's where I think a lot of people are focusing on the economic risks that, in my opinion, are not real. We have a growing economy. We have wage growth, stubborn wage growth. Yep. You have job hiring, not in the sectors I like them to be, but you still have hiring. So so the market is focusing on what I don't think is a real economic risk, but where the market is not facing or focusing enough on is what I think are the very real geopolitical risks.
Yeah.
I talked about this on TV recently. I mean, have you followed what's happening in the Red Sea right now?
Some, yeah.
So just think, if you're a company that wants to ship your goods through the Red Sea, the Suez Canal, which that area of the world, 10% of global trade goes through the Suez Canal. It's incredibly important. Since November, we've had over 20 attacks on cargo ships by Iranian-backed Houthi rebels. So if you're a company, let's just say you're an automotive company, you're a Toyota, and you want to send a ship of your cars through the Red Sea, you've got to now make a decision. Do I send my cargo through the Red Sea and risk being attacked by Iranian-backed Houthi rebels? I have surging insurance costs. Or do I go 4,000 miles around the coast of Africa, lose 10 days in each direction, and have significantly higher energy costs? And that is a cost that these businesses are having to make. Mm-hmm. I think we're not talking enough about, I think this is the initial beginning of what could be a very real conflict in that region. You already have Russia-Ukraine, that the U.S. is supporting Ukraine. You've already got the Israeli-Hamas war. U.S. is supporting Israel. I don't see why President Xi would not try to make a move on Taiwan in 2024. Yeah. That, to me, is the risk. Does that send stocks down 80, 90%? I don't think so. But I think we could have a 3-front conflict in Europe, in the Middle East, and China that is not going to be good for U.S. markets and U.S. stocks.
Yeah. I mean, in any kind of big geopolitical risk where the U.S. wants to get involved, rightfully so, from an ally's sake, is going to cause more volatility in the stock market. Yeah. So.
And it's just, if you look at why does Taiwan matter, there's a lot of reasons. Maybe we'll do a podcast on the history of that. But it's semiconductors. Semiconductors chips. Power chips the world. Our computers, our phones, our automobiles, our smart cars, our electric vehicles. You can't run these without chips. Taiwan is the largest producer of chips in the world, which is why we're trying to bring some of that production here at home. But that's the real risk, and that shuts down the economy. If you can't get access to semiconductor chips, it's a big risk. And so to me, that's really where the real risk is. But when it comes to the economy, I don't see any real risks. I really don't.
Nothing certainly would suggest 80 to 90% losses that
Absolutely
year.
not. No.
Geopolitical risks, again, I'm with you. I wouldn't see maybe 80 to 90, but would it cause a significant downturn in the markets? More than likely. Yeah. More than likely.
So we'll give Harry Dent some credit. They asked him, well, okay, where do you put your money that's safe?
Yeah.
And his response was, you may think gold is safe. And I actually think this is what he got right. Gold can still lose money.
Yeah.
Right. Just because markets are crashing, gold could go down. There's many periods of time where gold lost double-digit losses. But you know where he said is safe? He said U.S. Treasuries.
T-bills.
T-bills.
Absolutely.
And I thought the line was interesting because he basically said it's basically the U.S. government. I've said this a lot of times. Well, David, can I really have faith in the U.S. government? You can, because it's relative safe, meaning when you look at everything else, is there any other nation that has a stronger military, stronger economy than the U.S. government?
There's not.
No. So the safest place you can invest money, in my opinion, is U.S. Treasuries, which it's also a shameless plug. We started a treasury fund.
That's right.
That you can reach out to Aaron, one of our advisors here at the firm, to find out more about it. But treasuries, short-term treasuries are yielding
a little over 5% still.
Oh, 5%.
10 years are starting to come down, but short-term rates are still strong, which we've had before.
Yeah. So there's nothing wrong with saying, I want to get 5%, 5 to 6%, stay out of the market to see what happens. There's nothing wrong with that.
On safe assets, 5% is still a fantastic rate. I'd take that any day.
With inflation being around 3, you're getting 2% above inflation.
Real return 2%. I mean, if you can get 2% above the rate of inflation, that's a strong return.
Absolutely.
Right? That's a strong return.
Yeah. Okay, so let's talk a little bit about. So last year, obviously, we came off of a really good year, like we said. Nasdaq up 50%, S&P up over 20%. What does history tell us about when you're coming off of a really good year, like we had last year? What does that generally mean for the next year? Can we extrapolate anything from the data when we look back at history on that?
Yeah, we certainly can. So in going back, about 65% of the time, following a year where the S&P was up 20+%.
Okay.
Right.
What percentage of the time you said?
65%.
Okay.
Markets are still positive.
Okay.
Right.
Okay.
You're still seeing some gains. Now the gains vary, right? But you're still seeing an average return of a little over 11%. Right. In a year where the S&P was just up 20%, the next year still could have a good year.
Yep. Okay. So the data is in our favor that when you had a good year, like we did last year, 65% chance over the time, it's going to be a positive year. Average return is about 11%.
That's exactly right.
Okay. Now, is 65% all the time?
No, no, not. Right?
So let me be the contrarian here. So of course, there's going to be bad years that follow good years. If you look at this, if I go back to 1928, there were some really good years followed by some really bad years. Look at 1928. Obviously, you had the stock market crash, but you had a 43% return in 1928, followed by a 9% decline the next year. 1933, I would say this is still in that depression recovery. You had a 49% return in 1933, followed by a negative 1%. Let's go into some more recent years. Yeah, if you look at 1999, so you had the tech boom of the 90s. 99, the market did 31%, followed by a 3% loss the next year, so not horrible. 2017, that's a more recent one, 21% return in 2017, 4% loss the next year. The worst one, it really seems like, was more recent. 2021, market did 28%. That's that post-COVID euphoria. S&P did 28% in 2021, only to drop 18% the next year. But the interesting thing is the years that are down outside of the Great Depression, following good years, they're not significant losses.
Yeah, no one wants to lose, but in terms of what the markets could lose on a basis, which especially if we're talking recessions, right? They do tend to be mild losses.
Right. They tend to be mild losses. And 2022 was almost 20%, and you had inflation surging. We have the opposite of that right now.
Right.
We have inflation leveling off in some declining year-over-year basis. So the data and history would tell us that after a year like we had last year, this should be a pretty decent year for the market.
I would agree.
Absent geopolitical risks. Which, can we control what some Yahoo does halfway around the world? We can't.
No.
And that's the thing where I say control what we can control. We can't control that, but we can control how much that affects our portfolio. The interesting thing is, if you look back, good years tend to cluster together.
They do.
So if you look, let's look at something earlier. If you look at from 2012, 2013, 2014, those 3 positive years in a row, 15% return in 2012, 32% in 2013, 13% in 2014. Pretty nice.
It's great years.
If you look at the 90s run, that was 5-year run of more than 20% plus returns.
Incredible.
In the 90s. I don't think we're in the 90s. We also discovered the internet in the 90s. That changed the world.
Certainly.
So we're not certainly there. Well, maybe it's robots. Maybe that'll help.
Could be the next thing. AI has certainly been a big push.
We're a family of 5. We have 3 kids, and what that means is lots of laundry.
Yeah.
And so I try to help my wife as much as I can with that, but I swear, every time we finish the laundry, it piles back up.
More clothes to do.
And so I was like, well, babe, what if there was a robot that could fold laundry? And she was like, absolutely not. I was like, really? Like an actual robot? That she was like, I wouldn't want a robot in my house.
Oh, goodness.
So we're not there yet, it sounds like.
Saves you so much time.
It does save you time. But like the little Roombas, those are technically, that's what I was like, the little things that clean the floor.
My wife and I, we have 2 of those in our house. One cleans the upstairs, one cleans the downstairs.
You actually have an amazing story on your Roomba.
Oh, I don't want to tell it. I can't. No, be very careful if you own dogs and have a Roomba that operates automatically, especially if your dogs get sick. That's all I'm going to say. Not a very fun Sunday when we had to clean up that mess.
You came home. The Roomba was working. The problem is the Roomba was spreading things that it really shouldn't have been spreading.
It was not cleaning. Let's just say that. Yeah.
Okay, we won't go down that whole rabbit hole at all.
Yeah. But so, David, with all of the geopolitical risks that exist out there, the sort of unknowns of what the markets may do this year in terms of inflation, in terms of being an election year, right? What encourages you about investing in the stock market? How are you comfortable with what's going on in the markets right now?
Yeah, and that's actually a good point to kind of maybe bring it home here a little bit. All of what we've talked about today is talking about a very singular year.
Yeah.
Right? What do we think the market's going to do this year?
Yeah.
What did the market do last year? But when you think about investing, we really need investing is really 20, 30 years. Okay? That is really what matters. These 1 or 2 year moves for the market, they're important.
Sure.
But your portfolio should be invested in such a way that what happens for 1 year or 2 years in the market shouldn't derail your retirement or your plan whatsoever. And so what I would say is what really matters when you go out 10 years, I don't know if you have any data on 10 years for the market, but here you go. I have it right here. The average, so let's talk about long-term returns. The median 10-year total returns for the market following positive years were 173% total return, 234% total return, and 188% total return over the past 95 years.
Wow.
So what does that tell us? What will the market do this year? Well, me and you can put on our best analysis hat and probably get pretty close to what we think will happen. Yeah. But what does the data tell us about 10 years? It's never been negative.
Right.
It's never been negative in the last 95 years, a 10-year total return after a positive year. And not only that, it's not slightly up. You're talking 173% total returns over 10 years, 200% total returns over 10 years, 188% total returns over the past 95 years.
Yeah.
So what does this come down to? Long-term investment returns are really the only ones that matter.
Yeah.
Short-term returns, I know it may cause us to lose sleep at night. We can ruin our day, but it doesn't really matter in the long term if you are invested correctly.
Yeah, absolutely. And it's that recency bias where, you don't want bad things to happen. I certainly don't want accounts to go down this year. I don't want the stock market to be at a negative by the end of December. But when we take the approach of long-term investing, so if I hear you right, you're saying if we're investing in the stock market, are individual years important? Yes. But what's the goal of stock market investing? The goal of stock market investing is long-term appreciation.
That's right. That's right.
So I'm hearing you right there?
That's right. Well, also, how does that compare to how at Nicholas Wealth Management, how do we allocate clients' strategies in our bucket strategy?
Yeah, so many of you are familiar. We use a bucket strategy, right? Mainly 3 main buckets: liquid, income, growth. Liquid primarily used for emergencies, right? 3 to 6, 6 to 12 months living expenses in that bucket. You got a growth bucket. That's for long-term appreciation. We want to help maintain our lifestyle, beat inflation over time. But remember, that's a 10-year bucket. The bucket over there designed really, we can touch it. Of course, we need to, but designed not to have to touch it for 10 more years because we have an income bucket set up to preserve our capital, still get a nice, still want to earn interest and dividends in that bucket, but really to help preserve our capital so it'll be there when we need income.
Yeah, and I don't know if I can stress this enough. Stocks were not meant for retirement. David, what in the world are you talking about? I'll say it again. Stocks were not meant for retirement. Mm-hmm. Wall Street has done, I would say, the greatest marketing job on the American public in American history. Mm-hmm. Somehow Wall Street has convinced us that stocks were meant for retirement. If you ask someone 40 years ago what they had for retirement, do you know what their response would be to you? What they had for retirement?
They got a pension.
They had a pension. Right, a pension that would pay them monthly income every month for the rest of their life. If you told someone 40 years ago, well, when I get to retirement, I'm going to sell some of my Apple stock every month to help pay for my utility bill and pay for groceries, they'd say, what in the world? Yeah. Because when you own a company, when you're an owner in a business, I want you to think of it, whether you own a pizza store on the corner, whether you own a laundromat, whatever your small business is, if you are an owner of that business, you're not trying to sell pieces of your business every year. Mm-hmm. You'll get income off your business, so stocks pay a dividend. That's great. Mm-hmm. But the whole idea is that business will appreciate over time.
That's right.
And one day in the future, you can sell it and liquidate. But stocks are meant for long-term appreciation, which is why for our clients at Nicholas Wealth Management, we have that 3-bucket approach. Our liquid, like you said, Aaron, our income bucket, which that's giving us income, and then our growth bucket. Look, we want money in the stock market, but I want my stocks to be money that I'm not touching for 10 years.
Yeah, at least.
I always get, in some ways I like roll my eyes when a client calls and says, hey, David, I'm pulling my money out of the stock market. And I'll say, well, is this money that you need this year?
Right.
Well, no, we've got our income bucket. So this is money that you need that you won't touch for 10 years.
Yeah.
Stay invested. Well, David, the market's down 20%. Stay invested. Well, David, there's volatility. Stay invested. Yep. Because what the data tells us, you stay invested over a 10-year period, you're going to have historically sizable returns over time. So is the market crashing 90% in 2024? I hope not.
Probably not.
I hope not. The odds are, history tells us that it's not. And that the data actually tells us if we stay invested through these turbulent times or be buyers during these turbulent times, it can pay off significantly.
So don't go sell my stock to pay my mortgage bill, correct?
No. Yeah. There's the whole tax penalties that
go
along with that, which you could, as a CPA, you could tell us a lot about. Yeah. So awesome. Well, good stuff. Well, I appreciate you joining us here for another week of Retire Ready. It's been a great time being back and spending time with you, Aaron, and just know you can reach out to our office at Nicholas Wealth. Mm-hmm. If you have any questions at all, we'd be honored to help if we can.
For sure.
We'll see you on the next episode
of
Retire Ready.
Thanks, David.
Bye-bye.